Palantir stock has been trending in popularity recently, and many people are wondering if they should buy more, sell what they have, or stand on the side to wait for a better timing. As the market is still very volatile at the moment, especially for growth stocks, we should always be careful about which ones to pick and what are the exposure and timing. Over the past few days, the price action of Palantir has brought the stock to around $13.10 before stabilizing around $12.22. The short-term price action of Palantir has been showing some uncertainty of the shareholders to make a decision about where should the stock go next. The price ranged within the $12 bound, which can be seen as an encouraging sign that the stock will no longer keep falling below that point, which still remains to be seen before we can make that conclusion. One thing that we know for sure is that the long-term price action is showing some very interesting price level, because historically, the stock has not fallen below $12 for a prolonged period of time. Of course, this is not an absolute science, and this support level can easily be bypassed if the shareholders collectively decide to do so because of one catalyst or another. However, I think that the market at the moment is not really looking forward to this, and that the stock is mainly influenced by the overall risk appetite of the capital, and that at some point the market trend will be reversing once again. For example, in early May, I'm expecting the capital movement to change from what it is at the moment. Now, let's take a look at the technicals of the stock. The trading volume of Palantir has recently been 15 million shares versus an average volume of 20 million shares. Over the previous 52-week period, its price fluctuated between $9.74 and $29.29. The market cap of Palantir is currently at $25 billion versus the enterprise value of $34 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the assets value may be impaired. At the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that a company is able to generate more profit or to have more growth than other companies, partially because it is assumed that they have a better management, a stronger brand recognition, and a bigger online following. It's basically what makes a company unique. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, since the enterprise value is less reactive to the market cap in volatile situations. If the company goes to liquidation, the goodwill would be gone, and we would be left with potentially less assets to distribute amongst shareholders and debt holders. When we compare the current price to the historical price fluctuations, the stock is 4% higher than the 1-month low, 27% higher than the 12-week low, and 27% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment on where the stock is going to go next, the implied volatility is 81% versus a historical volatility of 64%. The put-call volume ratio is currently 0.57. It's normal for many stocks to also tend to have a higher put option volume than what they deserve, as many institutional buyers hedge their long positions with put options. The most recent volume of options traded is 21,000 contracts a day versus the 30-day average of 92,000. In terms of open interest, the most recent volume of open interest is 3.4 million contracts versus the 30-day average of 3.2 million contracts. For the shareholder structure, institutional shareholders own about 34% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and State Street. It's relevant to understand the shareholder composition of a company, as this helps to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived more as an investment and not a short-term trade. Obviously, a lot of exceptions would apply, since there are great companies, mostly held by retail investors as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this is a sign that more organized shorting operations are occurring. Now, the current short interest is 6.5% of the total float, 40% of which coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out of the dark pools, it may suggest that there are institutional positions taken to short the stock. My recommendation for Palantir, based on my analysis, is to buy a significant portion of your allocated position now and to be prepared to hold it for the long term, possibly beyond the scope of the next 12 to 24 months. I think that Palantir will eventually regain its value in the eyes of the shareholders and that it will be able to reward those who are patient or very patient to see that day coming. This is why the position cannot be too large, otherwise it may affect the balance of the entire portfolio. I would recommend to commit between 3 to 5% of your portfolio. I would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into. not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.